Welcome back. In the previous two videos, we covered the CAPM and some of its many applications. It's a marvelous and beautiful theory. It makes sense. It's simple. It's just gorgeous. In this video, I'll have to cover a slight drawback. Is the capital asset pricing model true? No. So what? No model is strictly true. That's the point of a model. Models are designed to be simplified versions of reality. Now, there are models that can be good and useful and models that are bad or useless. But what you are not expecting is perfect realism. For perfect realism, you need reality. So, do the assumptions of the CAPM seem reasonable? Do its conclusions fit? So did high beta stocks outperform low beta stocks because they had a higher expected rate of return? We're going to discuss this in a few slides. The security market line, which we already have done, has the market beta on its x-axis and the expected rate of return on the y-axis. How should the security markets line look like if you knew the true inputs? Like this. So for each one, they all march in unison like little ducks behind mama duck and would be a perfectly linear line. Well, what if you don't have the inputs perfectly? What if you don't know the equity premium? You have some measurement error on the beta. There is not always the expected rate of return coming out, but we have many time periods. How should the same figure look like in the real world? Well, this is it. It should basically be a cloud of points, but it should be lying along the line so that on average, for stocks with higher beta, they have a higher average rate of return. And this, of course, here is an understatement. In the real world, you have negative returns all the time. This is just for displaying roughly how it should look like. Stocks with high market betas should outperform stocks with low market betas. That's the most basic insight of the capital asset pricing model. If you have a higher market beta, you have to offer a higher expected rate of return. Unfortunately, if you look at the real world, it doesn't look like this. The real world security markets line, which is this line that I just showed you here in this slide, which was the slide before, it's much, much too flat. It doesn't look anything like upward sloping at all. Now, one of the ways we can look at how this worked over time is take all the stocks in the market, take all the stocks in the highest beta quintile. That is, I stand here, I look at all the stocks, I pick the 20% of the stock which seem to have the highest beta, I stick them all into one portfolio. Then I take the 20% that have the most negative beta or the lowest beta, I stick them all into another portfolio, and I track these portfolios over time. So that tells me how high beta stocks have done and how low beta stocks have done. And if you look at this, here's the graph. And this is a really important graph for understanding what the CAPM says. So the blue line are the low beta stocks. The red line are the high beta stocks. And the first implication that the CAPM gives you is that the high beta stocks are the ones that should have given you the high expected rate of return. They are the risk contributing stocks. They are, from the perspective of diversified investors, the riskier stocks. And you look at that and it's just not there. Now, before the 1970s, there were a few years when high beta stocks really did better than low beta stocks. But ever since, the evidence has basically been nothing. Now this, what you see here, is not really statistically significantly different, but for sure it doesn't say that high beta stocks outperformed low beta stocks. That is the principal claim of the capital asset pricing model, and it's resoundingly rejected by the data. Never use the capital asset pricing model for investing purposes. I would also not use it for cost of capital purposes, which is what we've been using it for and which is what everybody in the world is using it for. I personally would prefer simple benchmarking and just presume that all stocks have a market beta of 1. But I am in the minority here. Most finance professors still teach the CAPM as if it were the gospel. Courts are using it. Regulators are using it. Most practitioners have been taught by finance professors. They just follow this recipe here. They believe that the CAPM actually holds. But it's not a deep insight. The evidence is not there for the capital asset pricing model. Higher beta stocks did not offer higher average rates of return. It's not my fault that the business world is still using a terrible model for its cost of capital estimates. This model was invented in the 1960s and has taken hold, and it's still being taught today. And a lot of the people that are in practice today, well, in the beginning, there was a reason for teaching it because for a few years it worked, but it hasn't worked in a long time. Now, I'm just the messenger. Don't shoot the messenger. It's not my fault that the people out there in the real world are using this model. They will expect you to know this model. In fact, of all the things that they may check that you understand finance, that may be the number one model that they may be quizzing you on. Furthermore, the CAPM says that the only thing that should matter is market beta. Other things should not matter. Things like momentum or value or profitability or greenness or whatever else. However, they did like crazy in the past. Now, I am skeptical that they will similarly matter in the future. So I am not as disturbed by that. But basically, in the past, if you had used some of these factors, you would have done much better investing. And even if the capital asset pricing model did work, for these corporate cost of capital estimate, the point estimates would be lousy. They would have terrible accuracy. It would be almost useless anyway, which is why I like a beta of 1 on everything. If you tell this to an interviewer, make sure to qualify it and to describe that you know what you're talking about. And this is not just pulled out of a head because you were too lazy to study the capital asset pricing model. Now, why has the capital asset pricing model not held? Yes. Now, why has the capital asset pricing model not held? Well, there are these things in there that we need to assume, like that you don't care about your house wealth or your labor income. We also assume that the market was nearly perfect. Especially we have assumed that investors all have the same opinion. They don't have different opinions. And that they're reasonable and reasonably invested. We also have assumed that everybody knows what the equity premium is. All of these were assumptions, and all of these can invalidate the model. In my opinion, the worst one is that I think people have different opinions. And as a result, don't hold well-diversified portfolio, but try to chase certain effects like Tesla. One of the implications of the capital asset pricing model is that you shouldn't hold the stock market anymore the same way that you would before. You would tilt your portfolio more towards low beta stocks because low beta stocks should have lower expected rates of returns, which means higher prices. But in real life, they still offer roughly the same expected rates of return. So they give you this insurance almost for free. Why is it that not everybody is doing that? Well, everybody should be doing this if they care about the CAPM model and all of the assumptions, which many people probably should. But there are also valid reasons why they may not want to do this. For example, there's many large investment funds that have mandates on what they are allowed to hold or what they are supposed to hold. Then there's lots of people that are trying to sell you this, that, or the other fund, and they all have to convince you that they have superior ability. And if they just sit there and then just hold the market portfolio a little bit tilted, well, how much real ability can they have in terms of timing the market? So there's a lot of agency conflicts and a lot of gaming and a lot of other things going about. Overall, it doesn't seem like investors are particularly good in beating the market, and the wisest investment advice is probably to tilt a little bit towards low beta stocks and call it a day when it comes to investments. The market correcting forces are not strong and they are not quick. So there's no easy way to earn arbitrage because the capital asset pricing model does not hold. You can get a slightly better portfolio with a slightly higher expected rate of return by tilting towards the low beta stock. And more investors may be doing this, but it's a very, very small amount of money. On the whole, you're still going to be fairly close in something similar to the S&P 500. Now, why is it that I'm asking you to learn the CAPM? Does the CAPM give you reasonable cost of capital estimates, which is what we're after here? Sadly, probably not. It's more like a stop clock. Twice a day, it works. I personally prefer assuming a beta of 1 for cost of capital purposes. Part of the reason is it's sort of a beautiful bedtime story. It's sort of the world operates how it's supposed to operate. It gives marvelous intuition. It's how it should be. It should be that investors care about their overall portfolio. And it makes internal sense. Under its strong assumptions, of course, this is how it should be. This is how I had expected it to be. I also would have to give you alternatives that are better. And the fact is, there's no standard widely agreed upon alternative. So I choose a beta of 1, but that's just me. My personal educated guess, debt has verifiably a lower cost of capital. Longer-term projects require higher costs of capital, but we cannot predict the expected rate of return for publicly traded large stocks depending on their beta. And as I said, I prefer asset class-based benchmarking, similar to assuming an equal beta of 1, so not trying to distinguish among them. Why is it that I'm forcing you to study the CAPM? Well, it turns out that most CFOs in this world are using it. All regulators are using it. The courts are using it. The IRS is using it. Other textbook authors are using it. Whoever will interview you for a job in finance will be expecting you to know this. If somebody wants to figure out whether you've taken a finance class, they will ask you about the capital asset pricing model. 73% of managers claim that they use the capital asset pricing model. Fortunately, it's actually not as bad as it could be, because even though they are using it, they don't set their hurdle rates, the opportunity cost of capital in the NPV formula to the expected rate of return out of the CAPM formula. They take that number and they add a few percentages to it. So they claim they use it, and they use it sort of as a beginning estimate, but they really don't. Now, if you're going to work in a company, 3/4 of these companies claim that they're using it. If you want to say, well, I'm an educated person, you got to know what it is that they're using. Here are some other methods that they're using. 39% says, oh, well, we just use whatever our historical average rates of returns were. Is that any better? Don't think so either. If you did this with Tesla, your cost of capital should be, 6,000%. 34% are using modified capital asset pricing models. It's not that it wasn't so bad the first time, it gets worse. And then about 15% are saying, well, we use either the Gordon dividend growth model, which I don't believe much either, or whatever our investors are telling us. There are no good, generally accepted models for the cost of capital in this world. The CAPM is widely, but incorrectly considered the best practice model. You have no choice but to know it. The noobs are in charge. The real reasons. Why is this still in use? Well, part of it is hazing. We haze people. We ask them to solve all these problems about the capital asset pricing model just to make sure that they suffer the same way we had to suffer when we went into this. Actually, the professors are doing less of that, And I wish I could avoid doing this, but because you are going to be in the real world and people are going to expect you to know the CAPM, I'll have to ask CAPM questions too. There's fake media. There's wishful thinking. People believe, well, such a beautiful model, it should work. There's people that are reality deniers. Oh, I do this evidence-free. It should work. Then there's people that are just ignorant. Those are probably the majority of people that are using it because 30 years ago, they were taught the CAPM by some professor from a bad textbook, and so they believe it actually works. It really does not work, and the evidence is not very subtle that you need. It's really the first order effects that you get here. Don't use the capital asset pricing model unless you are forced. Never expect any kind of accuracy from the capital asset pricing model. At best, what you will get are ballpark cost of capital estimates. Don't use it for portfolio investment decisions. Don't use it for short-term predictions, and don't use it for long-term predictions either. Another issue that we have here is that we may disagree over what the present value of a project is. So you may value a project, I may value a project. We may have different equity premium estimates, and that will give us different discounted cash flows. It's a problem. I cannot tell you which one the right equity premium is. I can tell you what's reasonable and what's unreasonable, but there are huge differences here. So it's really, really hard to say. Now, the common beta estimates that people mostly use also stink, although you can get pretty good ones. So if you wanted to get this right, you could get it right. This is not the main problem. And the biggest one is it doesn't look like the CAPM is the right model for benchmarking either. There's some piece of cold comfort here. Your expected cash flows are probably going to be even worse than your estimate of the expected rates of return. It is what it is. Now, we're not covering the following at all. It turns out that academics thought they could devise very smart multi-factor models in which it's not just a market beta, but an oil beta, and this beta, and value beta, and others. All of them are pretty lousy as well. So don't think they're doing any better. Now what? What can we do in the real world? Well, even if the CAPM holds, benchmarking can still work. It's just that the kind of firms that you would use may not necessarily just be dependent on the beta, but maybe similar firms in the same industry and same size. You could still work with them. Even if the CAPM fails, and this is the important part, and we know that the CAPM fails, benchmarking can still work. You still need the good benchmarks. Okay, that one I cannot get you around. And without the CAPM, I cannot even tell you what is a good guideline for what the right benchmarks are. That's what it is. That's how life is. In the land of the blind, the one-eyed man is king. And I have just made you into a 1.5-eyed man, or woman for that matter. So if you think about this, the people that are still using the CAPM are probably totally blind. You at least understand a little bit better here. But be aware, keep up with this, because in the future our inference may change, the world may change. You better have a good eye doctor. That's it for this video for Chapter 10 and for the capital asset pricing model. Chapter 10, halfway. We all wish the CAPM had held better, but it didn't. I also can't offer you anything a whole lot better than just a basic risk-neutral model for stocks and some risk basics across asset classes. In the next chapter, we'll go back to basics. We'll look at what happens if the capital market itself is not perfect. Maybe that is at the root of the problem with the capital asset pricing model too. Now, covering incomplete markets also means that we will complete all the possible scenarios that we need to cover when thinking about any possible real world. See you soon. Bis bald. How do you confuse in economics, Professor?
How?
Ask them to explain the real world.
Not this one.